Australia's economy is slowing down, the Aussie dollar is high, unemployment levels are back up again, and trade with its biggest importer, China, has also reduced. This is a far cry from how the Australian economy was faring earlier in the year, and the speed in which it's happened perhaps goes to show how serious the global slowdown is becoming. But now Australia faces a new problem: how to accommodate China's growing desire for piped gas over liquefied gas. Well, on the line from London is Macro Economist Stephen Pope. Stephen, Australia is trying to boost and maintain existing trades with China as much as it can. What problems is Australia facing in terms of gas supply, though?
China is about the second or first even largest consumer of gas in the world at the current time. And that makes them very price sensitive. So they have been looking at alternatives to the liquefied natural gas, or LNG. And it's been clear that piped natural gas, of which there is an abundance in Eastern Asia, has a situation where they can enjoy a 2% price discount by taking piped natural gases against liquefied natural gas. So they've been slowly shifting their demand over to PNG coming from Turkmenistan. They are opening negotiations with Kazakhstan. A new pipeline is also being built from Myanmar. And perhaps these long rumbling negotiations they've had with Russia as to the price of resources that Russia supplies into China might finally be reaching a resolution. So it really puts a bit of a dark cloud across the prospect for Australia to continue exporting LNG from the 5 ports that sit across the northern coastline into China, and that's going to be a big problem. The reason it's a big problem is that as this second half of the year has begun, we've already seen that many of the mining and resource companies have started pulling back on their expectations, paring their investment programs. And it looks as though, unless the Australians can find another natural customer for all the LNG they can provide, up to $100 billion worth of infrastructure investment might get cancelled in the coming year. And that's going to have a detrimental effect, not just upon that industry, but also on the Australian economy.
Now, we've seen unemployment levels dropping in recent months due to booming trade with China, but today it rose to 5.4%. The government had better get moving finding an alternative to its reliance on trade with China, hadn't it?
That's right. I think what you're finding for Australia is that the unemployment rate today was at 5.4%. We've been looking for 5.3%. Now, it's strange that that increases at the same time the number of people actually being employed has increased. 14,500 were added to the payroll. That's around 3 times the figure that was generally expected. And this is purely a result of the good first half economic performance that Australia had, where growth was above 4%, has drawn more people into the labour force. So people in work and people seeking work now totals around 65.2% of the total population, up from just under 65 a couple of months ago. So really Australia has got to find a way that they can continue to satisfy the demands of job seekers, but find a way that the economy can grow aggressively into the second half of this year and into first half of 2013, rather than just saying commodities are going on to a slump and so the economy itself will be on the back foot. But what we've seen is that that correlation of growth relative to energy and commodity exports is just huge. It's almost a one-to-one. So if that key industry is put onto the back foot, it's clear that the economic performance is going to deteriorate. And even if more people are looking for work, the unemployment number is going to slowly tickle higher, and we could easily be getting into the realms of 5.5, 5.6 or so, which would cause big headaches for the government.
Now, what about the high Aussie dollar? That can't be helping much, especially as far as exports are concerned.
That's right. I mean, running into the unemployment numbers that were released this morning, the currency was above 1 to the US dollar. It was trading around 1.02, and we thought there was a risk it could go out to 1.05, particularly if numbers were poor. And what we've seen is that because it's a strong number, it really has taken away all the optionality for the RBA to go and cut rates from 3.25%. So what we'll probably find is that the currency is actually going to settle below parity once again, and we're looking probably towards a drift down to 0.96 relative to the US unit.
Okay, so looking ahead then, what are your final thoughts on how the Australian economy could fare in the coming months?
What I think is going to need to be is that the current Labour administration have to have a rethink upon how they offer incentives to business. They're going to join the whole developed world trying to lure R&D enterprise startups, IT startups down into Australia. Clearly it's a business-friendly hub and it can work very well as a portal, a gateway into the wider parts of growing Asia. Also, the links into Brazil wouldn't be too difficult. But generally speaking, I think the Australian government has to have a serious rethink that it cannot rely upon the one pillar of strength, which has been commodities so far. They have to look at other areas, perhaps boosting the financial services sector. Maybe they could attract business that way. But certainly, I think a big push in attracting new startup business and cutting some of the red tape that's still there.
Okay, thanks for joining me today, Stephen. Economist Stephen Pope there with his analysis on Australia. That's all for now from me. Don't forget to check back for the latest updates and exclusive interviews here on Dukascopy TV. But for now, goodbye.